Okay, I know what you're thinking. Insurance companies are so boring. And I agree, they do seem like they're one of the most boring investments that I could investigate. So let me phrase it another way. How much do you like making money? And what if I was to tell you that there is an overlooked industry with a lot of people that are not interested and 90% chance of making big money? And if you're like me and you like making money, well, this now sounds a little bit more interesting. Now, if you can get to the end of this video, hopefully you'll be a little bit more excited about insurance companies. Well, that's the hope anyway. So at the end of this video, I will give you a company to investigate. But stay with me because I need to explain basically how insurance companies work. Because if you can understand a little bit more about how they work, well, then you'll be able to understand it as an investment. Okay, so firstly, let me just say that without insurance, well, the world would be nowhere near as progressed as it currently is. And after thinking about this a little bit more, I actually now think that insurance is one of the most important inventions of all time. I put it right up there with, say, electricity. And the reason it's so important is because it allows people to take risk. See, with insurance, people can go about their daily business lives without the risk of complete financial ruin. And the reason is because the risk is actually spread out amongst the community rather than the individual. So do you like playing poker or maybe blackjack? Well, insurance, well, it's a type of gambling. It's all about calculating risk. So here is the simplest example. I talk to my friend Jeremy, and I say that I'm scared to drive my car because if I crash into a Ferrari, well, I'm going to go bankrupt and I can't afford to fix the Ferrari. Jeremy then says to me, well, how about you pay me $100? And if that event actually happens, well, I'll look after those costs for you. And this is insurance. Now, Jeremy does this with tens of thousands of people and now has millions of dollars. So if one out of, say, 1,000 people crash into a Ferrari, well, he has plenty of money to fix that Ferrari. And I'm happy to give him $100 because if I crash into a Ferrari, well, I'm not going to go bankrupt and have to sell my house. Plus, because it's an event that I don't want to happen because being in a car accident is dangerous, well, I have no incentive to just crash the car and get the insurance money. That would be stupid. So I am happy and Jeremy is happy, and Jeremy has to make sure he has enough money to pay out to people if more than one person hits a Ferrari. So it's up to him to decide what are the chances of this event happening. And that's how he decides that it is fair to charge the $100. By the way, if anyone wants dinosaur insurance, well, I can cover you to up to $10 million and all it's going to cost you is $5 a year. Maybe a dinosaur comes along and damages your house or your car or bites off your leg. You want to be insured, right? Interestingly, well, pirates back in the 17th century was the reason that the insurance industry really got started. See, captains of ships, well, they were scared of pirates and they wanted to protect that investment somehow. And Lloyds of London, well, this is how the most famous insurance company of the world got its start. Okay, now let's go back to my friend Jeremy. See, he is called the underwriter because he is responsible to pay out if I crash into a Ferrari. So he is a bit worried that a lot of people might crash into Ferraris. Say if more than 20 people crash into a Ferrari over a 2-year period, well, he won't be able to afford to pay and he will go bankrupt. So he then goes and gets insurance on his insurance company. And this new insurance company is also called an underwriter. So other insurance companies insure each other, sometimes more than one. Maybe a group of, say, 20 insurance companies will insure Jeremy. And this is actually a really good thing for me because I want to be paying my premiums to Jeremy and I want to be guaranteed that if something does happen, like me crashing into a Ferrari, well, I want to make sure that I get that money. Because the last thing I want to happen is I crash my Ferrari, but a lot of other people have crashed their Ferrari. Jeremy goes bankrupt, and then I don't get my money for the fixing of this Ferrari, and then I go bankrupt too. So insuring the insurers, well, we actually need that as well. So the risk is spread out amongst lots of different clients and lots of different insurance companies as well. And therefore, no individual or no specific company is going to take a big loss. Insurance, well, it's vital to our world. Without it, we would probably regress very quickly back to the dark ages because everybody would be too scared to take any risk. They would be keeping all their money under their mattresses and they'd be too scared to leave their house because something crazy might happen to them. Now, to say that Facebook, Apple, and Tesla are important companies, well, they are not even close to as important as the insurance companies. Here is a list of some common insurances that you can get. For example, I don't have dental insurance. I look after my teeth. And I think if an accident was to happen and I say chip my tooth, well, I'll just have to pay the $1,000 to get it fixed. I think that it is highly unlikely, and I also have the money that it won't financially ruin me if this event occurs. But I do have things like medical insurance because if something bad was to happen for me medically, well, that could financially ruin me. Okay, and now I'm going to talk a little bit about the current insurance industry. Firstly, the industry, in my opinion, is one of the safest industries in the entire world. Pretty much every industry has changed dramatically over the past 50 years. Think healthcare, technology, online shopping. But insurance, well, it still works pretty much exactly the same as it did back in the 17th century. Of course, it's become a lot more regulated and a lot more competitive, but the actual idea of insurance really hasn't changed. And because the landscape is very competitive, well, that's really good news for the consumer because the fees are now really low as they can possibly be. But what is beautiful about the insurance business is that they receive all of this money up front and then they pay it out later. And in the meantime, well, they can invest this money into the stock market or whatever investments they like to make as much money as they possibly can. So an insurance company that can invest wisely, well, they can make a lot of money. And if they make a lot of money through their investments, well, that makes them a safer insurance company. Because if they make more money and some crazy event happens and they have to have a lot of payments going out, well, they should be able to afford it because they've been making so much money. So that leads us to the question of how do we decide whether an insurance company is strong or weak? Now, there are lots of different metrics, ratios, and elements that people look at when they're valuing an insurance company, but I'm just going to show you what I think are the most critical. The first thing I'm going to look for is return on equity. Now, this will show us how good the insurance company is at investing their money. The higher the return on equity, the better. Now, I want to see it greater than 10% consistently, and 15% is really good. Number 2, the combined ratio. Now, this is a very insurance-based ratio, and it will tell us whether the company is making more money than the claims it has to pay out. Obviously, that's important, right? What I want to see is most years it being under 100%, because if it's over 100%, well, that's a bad year because many claims were paid out. 1 or 2 bad years are okay, but generally we want to see this under 100%. Number 3, what type of insurance is it? See, life insurance is a bit more risky, as the payouts to the family are really big, compared to, say, car insurance, where the payouts are comparatively smaller. Life insurance is still investable, just we need to see a really good margin of safety. Number 4, a growing customer base. That's pretty simple. I want to see that the insurance company is growing their net customer base. Every year, some people are going to cancel their insurance or forget to renew, things like that, but we want to see more people signing up than leaving. And number 5, price to tangible book value. Now, this is when I'm looking to see if the company is a good investment. If I'm happy with all of the things above, then I also want a really good price. So price to tangible book value is the price I can buy the shares on the stock market in relation to the value of the company's net assets. Now, I take out intangibles like goodwill and other intangibles because goodwill is things like the value of a brand. Now, companies put a value on the brand, just like the brand name Gillette is a powerful brand name for Procter & Gamble. It is worth something. But if the business was to completely stop and sell everything, well, you might not get anything for this brand if the company won't make that product anymore. Therefore, to be safe, I like to take out goodwill and all those other intangible assets. So if the price to tangible book value is 1, well, it means that the share price is exactly the same value as the tangible net assets. So if the company was to completely close down, well, I should get my money back as a shareholder. Now, if the number is above 1, well, I wouldn't get all of my money back. And if the number is below 1, well, I'd actually make a profit. I've always thought it'd be a really smart idea to buy a business at 0.5 tangible book value. And then once I'm in control of that company, well, then just sell off all the assets and then double my money. It sounds pretty simple, right? Well, one day maybe I'll do this when I have enough money. Okay, so you stayed right to the end, and I promised that I'd give you a company that I'm really interested in. Now, I actually heard about this company from one of this channel's subscribers, so big shout out to, I can't remember who it was because it was a long time ago and I can't find the comment, but if you're that person who told me about this company, I appreciate that a lot. And a big thank you to everyone who leaves a comment because it really helps and it inspires me to investigate companies that maybe I wouldn't have normally found. Anyway, so the company that I want to give you for further investigation is called Unum Group. I'm going to do a deep dive into this company shortly, but I just thought I would give it to you now because it's a very interesting company. Now, because I haven't done my deep dive research into this company, I'm not recommending this at all, but I think it's a really good company to go and have a look at. And I'm also going to do a big video on lots of different insurance companies sometime soon. So if you could leave a comment about which ones you'd like me to analyze, well, I'll make sure to add it to my list. I hope you're not so bored with insurance companies now, and I hope that you're also a little bit interested in some of the companies that I'll do a lot more research on and see if I can find a hidden gem or two. So I hope you like this, and I will see you in the next video.